Thank you for joining me. My name is the Battleground Investor. I, if anybody's been looking at this portfolio recently, or since February, probably, you're going to notice that a lot of stocks are going down. It's tended to be explained away as, hey, these are high valuation growth multiples that are speculative in the future, like the speculative technology stocks, like Unity, Tesla, even to some extent, which is like the least speculative in a lot of people's minds for that, type. The ARK funds, those types of stocks seem to be just trending down all the time. Why? What's going on? And it's complicated, and I'm going to try and boil it down as simply as possible. But there's something more concerning that got me to make this video tonight for you guys. One, we got to understand the relationship between the bond market and stock market. And basically, without going into really complicated financial economic explanation, which I could do for another video, post in the comments if you want that. But basically, the interest rate on the 10-year bond is going to be used in calculating the prices of all stocks. And it's going to affect different stocks differently, depending on how much of the cash flow of those stocks is in the future compared to today. Future cash flow is going to be discounted more heavily by a higher interest rate, or in a 10-year interest rate, than a present day cash flow. So earlier in the year, when interest rates jumped really, really far up to 1.7, and I'll get back to Jeremy Powell here, but basically, when interest rates really skyrocketed earlier in this year, we see that it went right up to like 1.7, skyrocketed, right? I mean, this is not really that high in the history of interest rates, but for a lot of us, it is. But in any case, when the interest rates went really fast, really quickly to 1.7, that shocked the markets. People saying, oh, it's reopening, there's great inflation, and then data started coming in, there's a lot of inflation, etc. And this was growing fear, bond market was selling off, and the yield was rising as a consequence. Now remember, every month the Treasury bonds are being bought by the Federal Reserve because of a policy that the Federal Reserve has had since the depths of the crisis last year. So that's not the reason this went up. They didn't reduce their selling. They didn't reduce their buying. Just people started selling off. And then we've seen a trend back down. But during this period here, we've had a lot of those speculative growth stocks that, had future cash flows. They got hammered. They got nailed. There's the interest rates, as they were higher, people just sold that off, said it's garbage, and they keep selling it off. But interest rates have been going down. And then there was a collapse, and we claim this is the collapse, but people really started realizing here something's going on, and so they started saying, well, hey, maybe the transitory inflation argument is true. The information that was coming out on month-to-month CPI and PPI seems to be showing some movement in a positive direction in around May, and then people started saying, well, is there a growth issue? What's going on? Because, there's still inflation. Like this last month, the June's figure, we saw that there's a giant, spike in inflation, and we can see that. So people weren't so sure this month that, hey, is this really transitionary? This week showed a lot of kind of confusion. They've been confused for a lot of time, for a long period of time, like people fleeting between, is this transitory inflation or is this persistent inflation, with the bear saying it's persistent, getting to cyclicals and materials. But materials have rolled over. A lot of that CPI data has been coming in positive. Look at the CPI here, for instance. We've had positive going from 0.8 to 0.6. But then this month, that's when things again started to change. And it's gone back up to 0.9, for the last month, but this month people have realized it. And the same thing, like it's gone. Between March and April, it was a positive movement, but then May was bad. And so people weren't so sure. There's confusion. CPI, PPI are going in wrong directions. And then here, this reiterates, June reiterates the PPI in June reiterates. The June PPI is reiterating the June CPI. So what's going on? People are not sure. Is it really transitory? Is the inflation persisting for longer than we are expecting? The answer is it depends on who you speak to, right? But the market's just completely confused. What made it worse was really two things is making this worse. One, Jeremy Powell was grilled in the Senate and Congress today, this week, on Tuesday and Wednesday, if I remember correctly, and basically he admitted to that the Federal Market Open Committee and himself were shocked that inflation numbers are coming in month on month hotter than expected, year on year hotter than expected. He didn't say in those exact words, but he basically it said it, that they were shocked, and that one way or another, it's going to be transitory, and that he's giving it a 6-month window from this week, meaning till the end of this year, before they make a move on it. Well, that just made things even worse. It basically reignited, along with the CPI, PPI data that came out this month, the fear that the market has. The market is pricing in hyperinflation all over again. And our favorite stocks, growth tech stocks, and whatever else that you guys probably own, have been crushed. But what's really crazy is that the yield curve has been collapsing. Nobody can explain why is the yield curve, the interest rates. Why are the interest rates collapsing? And there seems to be inflation and the fear of inflation so high. What's going on? I made a previous video indicating the reason that I think it is, what's going on. And Janet Yellen, the U.S. Secretary of Treasury, has said her reason, where she thinks the market is looking through transitory inflation, knowing that the history of the United States is to keep inflation low. She's spot on. But it's being helped by. Of course she's spot on because she's the former Federal Reserve Chairman during the Biden administration. She's, I believe, an economist, a PhD in economics. Of course she knows what she's talking about. However, that doesn't mean that she's right, but in this case, I agree with her, and that's my opinion. You're watching my video, so if you don't like it, you can click somewhere else and get another person's opinion. However, for sticking around this far, thank you so much. If you find this information helpful, please subscribe, click like or dislike if you don't like it, and leave your comments. Tell me if you agree or you don't agree with what I'm saying. I really just want to know what you guys are thinking, because it's a very confusing environment, and I'm not going to claim I know the answer. I'm just going to tell you what my opinion is. So to get back to that, I'm looking at it and I'm seeing there's also another element to it. In a previous video, I talked about what I think has sped up the collapse in the interest rates from that high level that I showed earlier, where it's been collapsing, to today's level, around 1.3. And the reason I think this has been collapsing slowly, while most, I think 97% of professional fund managers that I see go on TV, and there was a survey even issued about that, had said that they expected this figure to go from 1.7 to 1.9. So what's going on? Foreign bond buyers, they've come into the market for the first time in years. The demand abroad is so high because their economies are deflating. The Delta variant is just ruining them. That's been moving these prices, the yield curve down, the interest rates down, as bond prices have been going up because they keep buying the bonds. It's an inverse relationship. And so that explains why it's been going down, along with existing, U.S. buyers who are agreeing more on the balance of things. More than 50% of them look like they're agreeing, along with foreigners, to be buying U.S. Treasury assets, U.S. Treasury bonds. And that had stopped the movement up and gone down. I think professionals were expecting 1.9 by the end of this year. We could still get there, but right now we are going in the opposite direction. But this movement has sparked another fear that, are we really in inflation, or are we in a deflationary environment? And Kathy Woods has an opinion on that. She thinks we're going to be in deflation next year. I don't think that's the case at all. But longer term, technology does have deflationary forces. That said, a small inflation is probably always going to exist with our economy. That's the way it should be, and that's the way it will be. It's always been that way. The economy keeps moving forward. The question becomes is, why could it be deflationary? Some people are saying it could be deflationary. This is showing a loss of inflation and a loss of GDP, that growth is falling. And that could be correct, but people don't believe that. And some people don't believe it, while some others do believe it. And so there's confusion. What I think is going on is the bond market is seeing through the transitory nature of the inflation. Overall, more money is being spent, along with the help of foreign buyers fleeing due to the deflationary negative growth effects of Delta virus abroad, to buy more treasuries than there are sellers. More buyers than sellers drive prices up, dropping yields down. But what's confused a lot of the professionals is that they expected it to go up. The stock market is now completely confused. It looks rather panicked. There's been a rolling over of cyclicals, which that's the anti-inflationary argument. So people pulled back on that and started going into the mega cap, excuse my language, mega cap growth tech trade. But they didn't go into all the way on the other side, which is the speculative growth. For that, the interest rates would have had to have fallen, say, maybe where it is today. But we still didn't see them go into the speculative growth, meaning they're not fully believing that interest rates will remain low like this. They're basically looking to the future, disagreeing with the 10-year rate, not fully believing it, giving them, they're waiting to see, is this 10-year rate going to spike back up soon enough before they reallocate their funds into the market in an appropriate way. I think that probably disconnects the likely that probably eliminates the likelihood of speculative growth coming back this year. People have just lost belief in that. So a lot of people who are holding on to those, thinking it's going to come back, I think that's a fallacy. Maybe in a couple of years, when people have regained belief that in the bond market signaling the correct thing, but right now people seem to be saying the bond market, I can't buy any bonds because the yield is too low. I've got to go into tech, but for that reason I've got to go into stocks, but I'm not going to go into cyclicals because the bond market seems to be telling me that there's either going to be a deflationary growth shock where GDP falling, or it's not growing as fast as it would have been that I expected, or that this is momentary, temporary, in which case I'm not going to let go of all my cyclicals, but I'll go into like mega cap growth tech because that's sort of, it hedges me against my cyclicals. That's how I'm reading it. I don't know. Give me your opinion on that. I hope this is helpful, but if you have any questions, just leave me comments. I'm going to review them and tell me what you think. Thank you very much. Have a great day and enjoy your weekend. Bye all.